2022 was generally a bad year for the stock market, but what does 2023 have in store? Hello, Happy New Year and welcome back to our channel. We are back with another look ahead video, and this time we're going to be talking about US equities, specifically US equity indices, and to see what their performance can bring in 2023. So before we get into it, please like this video, comment, subscribe, and turn on your notifications to be kept up to date with all the content that we post. So without further ado, let's get into this look ahead at 2023 at the US stock market. So the first thing I want to look at is a little bit of a recap of 2022, what we saw with US indices. So this is a chart here on TradingView, and we are comparing the performance of the three major US equity indices throughout the year and heading into the beginning of this year. As you can see here, the Dow Jones actually being the outperformer in the US equity index space, still ending the year lower, as you can see, down about 9%, but better off than the S&P 500 and the Nasdaq. So that is generally the picture that we get from 2022. As you can see, in general, we have this feeling of negative sentiment. We have this feeling of pullback in risk sentiment, and that was obvious in the stock market, not just in the US as well, in Europe. But here, as you can see, if we look from January to September, it feels like we can divide 2022 in two parts. The first one being January to September, where we saw that pullback. We did see some rebounds along the way, but generally the sentiment was skewed to the downside. This was on the back, of course, of the Federal Reserve leading central banks across the world in tightening their monetary policy, increasing their interest rates by over 300 basis points in a year. So all of that was being priced into the stock market, and we know that stocks love liquidity, and of course central banks being the gatekeepers of that liquidity. We saw markets really focused on central bank meetings and what they were doing, what they were, how they were impacting the liquidity in the economy, and of course subsequently in the market. So throughout the first 9 months of the year, we saw that negative sentiment, that downward trend. That started to correct at the beginning of September. As you can see here, we did trend to the downside still until the end of the month, but definitely in the fourth quarter, we started to see that rebound to the upside. That was most notable here in the Dow Jones and the S&P. The Nasdaq actually trading a little bit more flat in that last quarter. We know the tech sector was really weighed on in those last earnings season. So that, of course, having an impact there with those valuation and downgrades coming from those big names in the tech sector. But definitely the S&P and the Dow Jones, those more cyclical stocks, were starting to recover a little bit of momentum. Now, the Dow Jones actually underperforming the other US equity indices from that pandemic recovery from the lows in March 2020. So we had a little bit more room here to grow and to build up from those previous underperforming months. So the Dow Jones here really pushing above there, coming from around 20% loss throughout the year to back to that 9%. So we did see a nice recovery there. Similar with the S&P 500, not quite as impactful here, but nonetheless, we did see that rebound. And this was on the back of that change in perception that central banks were going to have to start taking their foot off the hiking pedal a little bit. The economies are starting to see some damage. We're starting to see those unemployment numbers ticking up. We're starting to see inflation data coming down. So that, of course, building into this big storm of market expectations that central banks will start unwinding their tightening policy soon. That takes us quickly into the fundamental picture into the first quarter of 2023. Fundamentally, I think the risk themes are going to be pretty much the same as what we saw in 2022. The main one being central banks and how the economy is going to perform. Now, of course, aside from the general broader risk themes that we've seen, most notably the war in Eastern Europe, the reopening trade in China, and how the economy and growth in general in developed economies is going to perform, we do have that main sticking point, and that is the Federal Federal Reserve. And I think the key question is, are we going to achieve a soft landing? And I think that is going to be the key theme behind the performance of US stock indices in 2023. I think there's two key scenarios to watch out for. One is soft landing and two is hard landing. The first one, soft landing, is actually the view that the Federal Reserve has it right. And the Federal Reserve believes that interest rates can be kept elevated throughout the year whilst inflation comes down and unemployment picks up a little bit but remains within a manageable area. So that is the key feeling that we've got from the central bank in their last meeting. Now, that is a key contrast to what markets are expecting. And let me tell you, yes, it has been updated since mid-December, but the Federal Reserve in their latest dot plot in December, we saw only 2 FOMC members seeing rates below 5% in 2023. I know the dot plot isn't hard science and it's not always something to go by, but it does give you an insight as to what markets are feeling, as to what, the Federal Reserve is feeling with interest rates, what they expect in the next few months. If you look at the market implied rates curve, we actually see a stark contrast there. It actually has come up, as I was saying. It's now expecting to see rates finishing around 4.5% in December 2023 compared to about 4.2% about a month ago. But nonetheless, we do have that divergence between peak rates suggested by the Fed and the duration of these peak rates compared to what markets are expecting. So if we do actually see a soft landing, rates will remain elevated for longer, which is something that markets aren't fully priced in yet. And that's where we see bond yields picking up and therefore stocks hurt or to a detriment of the stock market. So one, soft landing seems the Fed is right. We have higher rates for longer. Inflation is going to come down, not on its own, but of course the rate hikes that we've seen leading up to this moment are going to have their effect. And unemployment is manageable within a reasonable, mild recession. The contrary is we have a hard landing scenario, which is basically what markets are expecting. They're expecting data to worsen from here on out, and the Fed was going to have no other option but to start actually cutting rates in 2023. Now, if that does happen, we see bond yields taking a hit there, and of course the stock market picking up. We know, as what we've seen in the last few months, bad data is good data. So markets will be expecting that in the next few months. And we do see the unemployment rate picking up further, and we do see CPI coming in below expectations in the next few readings. Then essentially we are giving into the fact that the US economy is going to need help from the Federal Reserve to start unwinding all of these tightening measures that they've introduced in 2022, and therefore we see that divergence between the Fed and the market implied rate curve converging because the Fed has to come down to meet the market implied rates, and therefore the stock market sees a little bit of a boost. So that is generally the two scenarios that we may have in terms of central banks and interest rates. So now let's get into the technical aspect of this video. So let's start off first with the S&P 500. This is the Capital.com chart on the TradingView platform. And as you can see, that general pattern, that bearish retracement throughout the first 9 months of the year, and then picking up that bullish momentum throughout the last quarter as we saw that change in momentum from the Federal Reserve and expectations in the market. Now, if we are looking at the performance throughout the last few weeks, you see we saw that pullback there from the last meeting in December. That is when markets actually realized that Powell isn't as easy to give into these weakening data points. He wants to see more to consider changing the monetary policy. He's scared of under tightening and therefore having a greater impact on the economy further down the line. So he seems to be pretty stern on the fact that he still sees a need to have higher rates for longer, to continue interest rate hikes throughout the first quarter of 2023. And it's going to take quite a bit of negative data to change that rhetoric from him. So we saw that pullback from that meeting. And then we saw a classic turnaround Tuesday here on the 20th of December, picking up some momentum, but then finding that resistance. So To me, it does look like the path of least resistance remains to the downside. But if you are looking at how we've been trading throughout the last few weeks, we do see that resistance to give in to sellers. Even back here when we broke below the 200-day moving average once again here in mid-December, heading into that meeting, we saw that reluctance to really come down lower. We saw a lot of support around 39.13 here before that meeting, a push to the upside as well, cementing this peak around previous resistance. So it seems like, yes, it's going to continue to trade lower, but there is resistance or reluctance to actually really come down significantly and to give into that selling pressure. Similar momentum has happened throughout the holidays, as you can see. We traded sideways, attempted to break higher in a few attempts, even as early as Tuesday here. We saw that momentum building to the upside and then reversing once again. So it does seem like we are attempting to break higher, but just finding a lot of resistance. And of course, these moving averages here converging, I see that as a great risk for buyers. I see that as a really tough area to break. And I think the fact that markets aren't yet fully convinced that the Fed is going to it's going to keep rates higher for longer, and the fact that leading indicators suggest that earnings per share are going to take a hit in the first quarter. I think there is more risk to the downside for the Dow Jones, for the S&P 500 at the moment. And I think the technical pattern supports that. Moving averages are now fully stacked on the dovish side, on the bearish side, as you can see. And then we've got that 200 days still quite a while away now as we're pushing away from that area. So I think the path of least resistance for the first quarter is going to be lower, especially if we remain below this descending trend line from those highs in 2022. But nonetheless, I do still see a little bit of sideways consolidation as we attempt to break higher, but find resistance along the way. So I don't think it's a clear pattern to the downside. I think that retracement continues to play out lower, but I think there is going to be a good amount of support as we move along the chart. As you can see, evidence here from the beginning of the year where we have seen, once again, that reluctance to give into sellers. Let's quickly take a look at the Nasdaq. Similar pattern here as well to the S&P. I'm not going to repeat what I've already said, but 2022, the same thing. We are below the 200 DMA, also below the trend line as well. In fact, the sentiment is even more bearish here for the Nasdaq. We know it was the best performing equity index, US equity index, from the recovery of the 2020 pandemic lows, but that also meant there was further room to retrace throughout 2022, and that is indeed what happened. We also have that similar pattern unfolding, that retracement from the meeting there, from Powell's comments, a little bit of an attempt to break to the upside, but really not holding at all. That consolidation also not happening. We're not really seeing much sideways trade here for the Nasdaq. It's more of a case of higher highs and higher lows, and then reversing to the downside. And I think one thing to note here is the fact that we have actually broken below the fourth quarter trend line support. That happened here at the end of December, and it's actually now acting as a pretty good area of resistance. So again, the Nasdaq, path of least resistance to the downside, even more clear than the S&P 500. We don't have as much support from buyers. And I think, of course, the tech sector and sentiment around earnings for the tech sector in the first quarter has a lot to do with that in the Nasdaq. So expect trend to the downside in the Nasdaq, potentially even stronger, more stronger than the S&P. And then let's quickly take a look at the Dow Jones. Different pattern here, actually, and we saw that in the beginning where we looked at the performance of the equity indices throughout 2022. We've actually seen a lot more bullish momentum holding still above the 200-day moving average, finding a little bit of support there at the end of December, and actually above its above its trend line for 2022, which is the only one of the three majors in the US that has managed to do this. The 20-day converging close to the 50-day, suggesting potentially a little bit of weakness to come in the short term. That sideways consolidation also happening here for the Dow Jones. But I think if there's an equity index in the US that is going to fare better than the others, it is going to be the Dow Jones. I think that 2022 momentum is going to continue. The path of least resistance, not as clear here as the other two. I think we do consolidate sideways a little bit more than we've seen in the others. And I think we may see a little bit of an upward tilt if we manage to see comments from the Federal Reserve suggesting that, in fact, market implied pricing is starting to be a little bit more accurate. The data is worsening and therefore allowing a little bit more wiggle room for the Federal Reserve to adapt its monetary policy. Again, not a clear move to the upside, but not a clear move to the downside either. So this is probably the one that I'm more neutral on. As I said, we may see those lower lows coming in, but also potentially higher highs along the way. It might be a bit of a wave pattern like we've seen, those buyers and sellers really battling it out. I think in general, you got to have a bit of a negative sentiment for the stock market if you expect the Fed to be right with their higher rates for longer scenario. But out of the three, the Dow Jones is probably the one that I'm most neutral on. And if I did have to suggest one to be bullish on in the first quarter of 2023, it would definitely be the Dow Jones above the S&P and the Nasdaq. That is it for the 2023 outlook for the US equity indices. Thank you for watching and don't forget to subscribe to our channel.